Today we are comparing the mega healthcare giants Eli Lilly and Company versus Novo Nordisk to understand which is the better one to buy now, which has a larger sign of undervaluation and looks better for future growth. We're going to take a look at the historical performance as well as run through their dividend safeties. We're also going to look at their financial metrics to understand the growth potential. We're also going to take a quick look at essentially any insider buying or selling over the last few weeks. We're going to compare the institutions, what they've been doing in each company, whether they've been buying more in Novo Nordisk or more in Eli Lilly. And as always, we are going to run through each one in the valuation model to get to the intrinsic value, get to our acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they are forecasting over the next 12 months. So let's start off in today's episode by looking at Eli Lilly and Company. Now this is one that is up triple digits, 133% over the last 12 months. It is currently trading towards the upper end of their 52-week range. And if you've been holding this over the last 10 years, you would be up in a staggering 1,238%. Now the current forward yield is 0.67%, not the greatest, but we can see some very strong shareholder price return. And the forward P looks very costly at 61.81, which we'll discuss later. In terms of the competitors, the Novo Nordisk, well, this is up 76%, still very strong over the last year. And over the last 10 years, not as strong, but still 470%. Similarly, it is trading towards the upper end of the 52-week range with a much larger yield forward-looking of 1.44% and a much more reasonable forward P of 37.81. So let's take a look at each individual company. Firstly, though, we can take a look at any insider buying and selling. We put their ticker symbol in. We've done at least 100 shares. And over the last month, we see the senior vice president from the finance department sell around 750 shares at just over $500,000. Now, as always, insider selling, not really a bearish signal, but we do always like to be transparent. And we can see since this person did sell on essentially the 11th of March, the share price has gone up 2.26%. Now let's take a look at Eli Lilly and focus on institutional ownership and portfolio movement. 81.38% as we can see. Now 46 billion worth of shares sold over the last 12 months. And interestingly, only a little bit less of buying, 43 billion. So what we note here is institutions have been selling more shares of LLY over the last 12 months than they have been buying. The largest sale came in Q2, but what we do know in the more recent quarter, Q4, institutions were buying more shares. But nonetheless, over the last 12 months, it has been more of a sell than a buy from these large institutions. Now, in comparison, Novo Nordisk, we see a lower institutional ownership, 6.41%. We have 1.54 billion worth of sales by these institutions over the last 12 months, but we do note a lot more buying, 9.4 billion over this same period, with the largest buys coming in Q3, although we do also note in Q4, the more recent quarter, there were also more buys than sells. So in comparison, we do see that Novo Nordisk is one of those that institutions have been buying a lot more than they have been selling, and we see the opposite there for Eli Lilly and Company. So few things to note. Nonetheless, let's look at their dividend safety and financial metrics. Eli Lilly, well, dividend safety 96, very safe. Market cap 694 billion. It is a mega cap company. Now, in terms of those recessionary metrics, well, they increased the dividend during the last recession. They had plus 3.7% sales above the S&P negative 12, and they also came in at a near recession return of the S&P negative 49 versus the S&P 500's negative 55. Now, dividend growth, love to see this. Double-digit increase last December, double-digit increase on average over the last 5 years, and just above that inflationary 4% over the last 20 years. To be honest, even at a 6% every single year over the last 20 years, you wouldn't be complaining with that share price return over 1,000%. Now we can see they have been increasing those dividends for the last 9 years. However, they have been paying a dividend for the last 33 without a reduction. Now, in terms of dividend yield theory, as always, states the company is undervalued when the current yield sits above the 5-year average. We see the opposite here. We see the yield of 0.67 below the 5-year average of 1.47. And we also note the forward P of 61.6, significantly higher than the 5-year average of 29.5. So this would typically give us essentially an overvaluation signal. But do remember, we don't look at any of these models in isolation, and we will conclude towards the end. Healthcare 17.7, Eli Lilly much higher. So we do see, compared to the sector, this is a company that is trading at a much higher valuation. In terms of the payout ratio, well, what we do note here is that in 2022, 75%, it is looking fairly high. Now, whilst it is higher than the 60% that we do like to see, it is positive to note that in 2024, it is expected to come down to 56%. We do note negative 263% in the more recent year. The reason for this, as we are about to see, is that they did have negative free cash flow in 2023 of negative 172, although we do note that this is expected to rebound sharply to $9.29 in 2024. And over the longer term, this is one of those that it is moving in the right direction, although we do see a few inconsistencies where it does fall after increasing from the previous year. In terms of the sales growth, well, as always, steady moderate growth, 3 to 7%. With this company, very inconsistent. Some years, like the more recent years, strong double-digit growth. 2022 essentially flat, and we get 2 of the last 10 years of negative growth. Something just to bear in mind. But as always, when we do look over the longer term, we do see this company has nearly doubled their top line from 19.6 billion to 34.1 in 2023. Now, they have also returned excess cash to shareholder pockets, reducing essentially the shares outstanding from 1.07 billion to 903 million, therefore giving you a larger stake of the pie. Now, in terms of the ROIC, what I want to see here personally, 10% or more to give me faith that management are able to effectively allocate their capital. Not only is it above that from 2014, but since then it has only been increasing, and the last year of 29% is very attractive for an investor. In terms of the margins, well, a strong sign of operational efficiency, increasing from 17% in 2014, 32% in 2023, moving in the right direction and very, very healthy to begin with as well. Free cash flow margin, other than 2023 where we do see it as negative, before then well above those 5% minimums we want to see. In fact, in the low teens, looking very strong. In terms of the net debt to EBITDA, well, this does show us essentially the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want to see, and remember that signals dividend safety as well as balance sheet strength. Now 2.74, a little bit too close to the 3 maximum we want to see, but it is expected to reduce dramatically to 1.61, so that is very strong, very healthy at that level. Something just to keep in mind though when you are looking at your margin of safety. Now we can compare this to Novo Nordisk. Dividend safety score 99, very safe, similar to Eli Lilly. Market cap, again, both are mega cap companies. In terms of those key metrics, well, actually they increased the dividend during the last recession. They had above average growth, and they beat the S&P significantly with their negative 27%. In terms of dividend growth, well, the last full year, 52%, absolutely outstanding. Double digit over the last 5 years and double digit over the last 20 years, making this a very strong dividend growth company. They're also a dividend aristocrat. They have increased those dividends for the last 25 years or more. In terms of dividend yield theory then, essentially very similar to Eli Lilly, we see a double sign of overvaluation with the yield below the 5-year average and the forward P sitting above that 5-year 28.6. Although whilst we do note the forward P is much lower than Eli Lilly, it is still above the healthcare sector P of 17.7. Free cash flow payout then, we can see it is below 60% for the majority of the last 10 years. 60% in 2023, 57% in 2024, and overall it is looking very healthy, especially considering their yield is much higher than LLY. Free cash flow per share also increasing, moving in the right direction, in fact tripled over the last 10 years, and unlike Eli Lilly, which had a negative 2023 free cash flow, $15.60 was very, very attractive and very well liked by the investors, expected to go up higher in 2024 to $16.40. Now, sales growth looking pretty strong over the longer term. Granted, we do have 2 years where the top line remained flat, although realistically negative when you factor in inflation. The last 3 years, strong double-digit growth to their top line, and we can see numerically 88.8 billion going to 232. very, very strong. Shares outstanding also moving in the right direction. They are doing a lot of share buybacks over the period. In terms of ROIC, absolutely phenomenal. One of the best ROICs we've ever analysed on the channel, 72% in the more recent year. In fact, in 2016, triple digits. But overall, very strong. There isn't really anything else we could want from this metric for this company. Operating margin, not only is it very strong, but it was also higher than Eli Lilly, 45% in the more recent year. And the free cash flow, not just very strong in 2023, but very consistent year on year. In terms of net debt to EBITDA, absolutely phenomenal. 0.1 in 2023, 0.08 in 2024, essentially saying it would only take them a number of days to pay off all of their debt net of cash on hand. So we have two very strong companies that have had returns, some very strong shareholder return. Let's take a look at the valuation. Just before we do though, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the other articles, sign up below and you can get instant access. So let's jump into the valuation. Don't forget, if you do enjoy these videos, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now on the channel, we do typically run through every single one of these models. Today's episode, let's just get straight into it. And for both of these healthcare companies, we have used the DCF model and the dividend discount model. So for today's episode of Eli Lilly, we get an intrinsic value of $760, which signals that with the current price at $770, that this is a company that is trading slightly higher than its intrinsic value, giving it zero margin of safety. And even with that, we can see the acceptable buy would be around $759, around $10 lower than this current price. But again, it does bear in mind, if you are looking at buying a company which is a premium company based on the metrics, then you may be looking at either a smaller margin of safety than 10%, or typically some of these companies do trade at the premium, as we do see right now. In terms of Wall Street and their forecast, well, over the next 12 months, they have a price target of $850. As we can see, they believe upside of 10%, so they do see it as a buy now. Maybe not the strongest buy, as we have seen other companies with much higher upsides, but it is one that they believe to consider for your portfolio. Moving on then to the next company, which is NVO, we can get to the intrinsic value, and for today's episode, this does arrive at $166. Now, with the current price of $129, this signals that there is some type of margin of safety. And remember, we always start off with 10%, and we use this if we believe it meets three criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, then you do see around 10% margin of safety and a price of $149. So it would be a buy now. At 15% up to $141, and at 20% not too far off the current trading price, but it doesn't have a 25% margin of safety. So even though it has gone on an incredible run and it is the higher yielding company, we do see this having a margin of safety of 20%. In terms of Wall Street and their forecast over the next 12 months, well, they believe a little bit less upside at 9% as opposed to 10%, but they do see a price target of $140. Now, personally, based on this information that we have run through today, my preference would be NVO, given the metrics were a lot better, not just in 2023 where we saw free cash flow positive, as well as a strong ROIC, but as well as just running through the other metrics. Looking at the valuation, I do believe there is some margin of safety. However, you could argue Eli Lilly has had a very strong return for shareholders over the last 10 years, but it is important to understand that past performance is really never an indicator for future performance. As always, based on this run through that we have gone through the metrics as well as the valuation at a high level, let me know your thoughts, which one you prefer to add to your portfolio. Maybe you already hold one in your portfolio. Don't forget as well, smash that like button, hit that subscribe button, and as always, we'll see you on the next one.